Hello, my name is Erik and I'm the CEO and founding partner of a firm called Consensus Wealth Advisors. And I recently published a book called Clarity: How Popular Culture is Misleading You About Successful Wealth Planning and What to Do About It. Please feel free to contact us to get your free copy. One of the things we've noticed is that our clients and friends have had a lot of questions about the book that were perhaps beyond the scope of the book that I wasn't able to address with the limited space. And so I wanted to shoot a quick video just to address some of those questions and hopefully provide some helpful, valuable information about wealth planning that you can use with your own family. So here's a question from Ben, and Ben asks about portfolio allocations. It seems to me this rubber-stamped approach of being more conservative with assets as you age stops making sense if you have more than you'll ever spend. Well, Ben, this is a great question. It really touches on and gives me an opportunity to talk a little bit about how we at our firm think about asset allocation and how it shouldn't be a rubber-stamped approach and shouldn't be some sort of formulaic approach to determining your asset allocation. So much of our industry and many advisors would talk with you as a client about an asset allocation as you're a 60-40, you're a 70-30, you're a 50-50, as if you had some rubber stamp on your forehead dictating what kind of investor and what kind of asset allocation you should have. And very often that asset allocation strategy is determined really with one goal in mind, and that is to achieve risk-adjusted returns. In other words, to achieve the best possible return we can while dampening your volatility of your portfolio enough so that you can live with it, okay? And while that may be a valuable approach for some, what we believe is really important is to achieve over time the best possible return from your portfolio, and then to train ourselves to live with the volatility that return may entail, and to psychologically and emotionally be able to deal with that volatility. So some facts about market history might be helpful. The first fact is that if we go back about 100 years, the return after inflation that's been produced by the stock market, the S&P 500, has been just about 7%. The return that's been provided by the bond market, high quality bonds over that same period of time after inflation, has been just about 3%. So historically speaking, on a real return basis, stocks have produced just about 2.5 times the return that bonds have. So as a rational investor, how could we ever counsel anybody to do anything but just own 100% of your portfolio in equities? They've produced 2.5 times the return. Of course, the reason is because equities also come with this thing that we call risk, which in our firm we actually think of as volatility. We really believe that risk means the possibility of permanent loss of your principal, while volatility means the temporary fluctuation in the value of your investments. And that latter, the temporary fluctuation in the value of your investments, has been the story of the stock market. So going back to World War II, there have been 75 occasions on which the stock market has declined temporarily by 15% or more. In fact, there have been 14 occasions on which we've had bona fide bear markets, in which the stock market has declined by 20% or more. Most of us watching this video probably remember in 2008 when the stock market declined by 57%. However, right when World War II ended, the S&P 500 was trading at right about 19. Today it's trading for about 2,700. So the S&P 500 has appreciated in value by about 200 times, despite the fact that it's had all of these occasions where it's taken these steps backwards. So the story of the stock market has really been a permanent advance in values and dividends, punctuated by temporary declines. So if we understand the stock market in that way, one of the things we can start to think about is, well, how can we maximize the number of dollars that we place into investments that are going to earn us something like a 7% after inflation return versus putting dollars into something that will achieve a 3% after inflation return. Well, there's another thing that's key to think about in this discussion, and that is, well, if we look at those bear markets, how long have they lasted? You know, how long have we had to wait when a bear market has happened before we get our money back? And so the other data point that's important is that the average duration of those 14 bear markets from peak to trough back to peak again, in other words, how long did it take me to break even, has been 40 months. So with all that information in mind, we adopt a thing that we call a time-based allocation strategy. And basically what that simply means is that we earmark dollars to a time frame of investment. So what we will do is we will create a bucket of investments that is designed to last us through a 5-year period of time. And those investments need to be conservative. Those investments need to be cash, short-term fixed income, investments that won't fluctuate in value. And then we will say that all the other dollars we own can be afforded to invest in what we call a long-term bucket, okay? And that long-term bucket can either be 100% equities or at least primarily in equities. And what that enables us to do is to say, okay, in our medium-term bucket, we've got sufficient money that we always know we can live through a 5-year period of time in which stocks aren't doing well. And we won't have to sell our stocks in a bad market because we've got a 5-year called a lockbox in place, okay? And then we know that those assets that are in that long-term bucket can be afforded enough time that we have a very high odds that even if a bear market happens, that money will come back, okay? Because the average duration of a bear market is 5 years. So when we think about it that way, what that enables us to do is to really become much more attuned to and much more oriented around those investments that are going to give us the highest probability of a higher rate of return. To make an example of this, a simple example, if I were an investor who had $100 million and I know that I spend $200,000 a year that I need from my portfolio. Well, if I simply put $1 million of my assets into treasury bonds, for example, I know that there will never be a 5-year period of time when I don't have enough money to live on and during which I would have to panic and sell my stocks if they declined in value. I could put $99 million into the stock market. I could have the confidence to know that that $99 million has at least enough time horizon assigned to it to weather through any bear market, and that $99 million gives me a much higher probability of earning a much higher rate of return than if I were to put it in fixed income. My asset allocation is 99-1, okay? Not 60-40, 99-1. On the other hand, another investor who has a similar profile, who had $10 million but needs to put $1 million in their medium-term bucket, well, that investor would have to have an allocation of 90-10. Someone with $5 million would have to have a much more conservative asset allocation. So that allocation decision should be more driven by your liquidity and cash flow needs when you are enlightened about the realities of the return and variability of equity returns over time.